What's up, everyone, and welcome back to the channel. If you're interested in investing into new dividend stocks, there have been 3 stocks recently that have caught analysts' attention. The first of which is Ellington Financial, which trades under the ticker EFC. Ellington Financial is a real estate investment agency that specializes in commercial mortgage loans and mortgage-backed securities. The company ensures profits for investors by utilizing a series of risk management tools to mitigate the natural risks that come with mortgage-backed securities. In their recent quarterly report for Q4, the company showed a consecutive increase in EPS for the 3rd time in a row, which was already up 38% from the previous quarter. For the full year of 2020, EPS came out to be 39 cents per common share on a total net income of $17.2 million. Ellington pays out a regular dividend, which is common for most real estate investment trusts. Despite the current virus, Ellington has been able to maintain regular dividend payments throughout the last 2 years. Back in March, the payout dropped from 15 cents per common share down to 8 cents, and since then, the company has been increasing its dividend payout gradually, and current payments are 10 cents per share with a 7.6% yield. Covering the stock is Maxim analyst Michael Diana, who believes Ellington is one of the strongest picks in his mortgage REIT coverage. Ellington's equities allocated 85% to credit assets, and almost all have done well. Of particular note are the non-QM loans and reverse mortgage loans. Not only has demand for these credit classes been high, but Ellington also has material equity stakes in companies that originate these loans, and thus, Ellington profits twice. With smaller mortgage companies going out of business, competition has decreased, leading to favorable pricing. The analyst goes on to rate EFC a buy, with the $19 price target suggesting an increase of around 20% near term. If we take a look at what other analysts on Wall Street think, we can see they are also bullish with a $17.25 average price target for around a 9% increase in upside potential. The next dividend stock is Dividend Energy, which, as its name suggests, is in the energy industry. Dividend Energy works in North America's most productive oil regions and controls over 10,000 wells with 752 billion barrels of oil reserves. In their 4th quarter 2020 report, Dividend produced 333,000 barrels of oil daily, which was a 7% increase from quarter to quarter. They also yielded a cash flow of $773 million for the 4th quarter, 34% of which was free cash flow. As for their dividend payment, Dividend Energy pays 11 cents per share along with an additional variable dividend of 19 cents per share. Covering Dividend Energy is Scotiabank analyst Paul Chang, who made Dividend one of his top dividend picks. We still see significant fundamental upside despite the year-to-date outperformance and the stock now trading at over 4 times its 2020 trough. We see little reason to expect that relevance, size, and liquidity concerns will prevent the stock from re-rating higher. As the company continues to deliver attractive fundamental results and execute on its shareholder-friendly strategy in the coming months and years, we expect Dividend to outperform as the market gains further appreciation for the story and begins to more fully reflect these fundamentals in the share price. The analyst goes on to give Dividend Energy a buy rating with a $30 price target suggesting a 31% increase in the near term. As for other analysts on Wall Street, Dividend gets an average price target of $24.89, which suggests an increase of around 9% in its share price.
But the phase that we've moved into now is the full development in the most economic zones. This has just happened in the last couple of years, so now we're going to be moving into much more predictable results in the best zones, and we're going to see much better economic returns, and that's going to really lead to better stock price performance.
Well, you think, because, I mean, to be blunt, Dave, is the industry is boom, production is boom. We talk about the shale revolution all the time. But the stocks have been dogs for investors for 10 years. Not everybody's stock for 10 years has basically been flat or down.
Yeah, and the other factor you have to remember, Brian, is their prices were $90 to $100 a barrel, and now we're down at $50 to $60 a barrel. And so that has caused the companies to totally retool their cost structure to really focus on just the most economic zones. And that's what we've done, though, as an industry. So it's been a tremendous retooling that's been necessary to be successful and to survive as a company.
That's the
but
irony.
that transition is now behind us. So the good news is we found a lot.
Do we need less production? Do we need slightly higher prices, Dave?
I think it depends on the company, frankly. Our company has really retooled our cost structure. We have some of the best plays in onshore U.S. that we're involved in. If you have high quality rocks, you can drill very economical wells. You're in low cost, you have a low cost structure, you can make money. Not everybody's going to be able to do that. There are going to be winners and losers out of this.
Just
we're confident we're going to be one of the winners.
I know we got a lot going on today, running out of time here. You guys looking to sell? Anadarko got taken out. Have you been approached to be bought?
Well, I don't get into things like that, but that's not our goal. Our focus is always to just maximize value for the shareholders through what we are doing internally. If that would happen, that would happen. But we're very optimistic about where we are. We have great plays, our cost structure is in line, and we think we have a bright future as we are.
The last dividend stock I wanted to talk about is OneMain Holdings, which trades under the ticker OMF. OneMain Holdings is a financial service company that focuses on assisting retail customers who lack access to regular banking and credit financing. For a specific niche like this one, the company still managed to make $4.4 billion in total revenue for the year of 2020. In their Q4 report, OneMain Holdings reported $1.23 billion in revenue and $2.67 in earnings per share. EPS also saw an increase of 43% from the previous quarter and was up 39% year over year. OneMain Holdings has a unique dividend policy that makes it different from other stocks like Ellington Financial, in which each second and fourth quarter the company pays out its minimum dividend of 45 cents, but the other quarters get a one-time boost supplement. The last dividend payout for the company was on February 17th, which was for $3.95 per common share. If we take a look at what analysts on Wall Street think of the stock, we can see that OMF gets a strong buy rating with an average price target of $63.60, suggesting an increase of around 31% in its share price. I hope you guys enjoyed today's video and that you found some value from the topics discussed. If you did enjoy it, please smash the like button for the YouTube algorithm. And if you want more content similar to this, then don't forget to subscribe and turn on that notification bell so you don't miss out on the next video. Finance Wizard, out.